AlphaBytes.
Welcome to AlphaBytes, digestible Q&A from experts at AlphaTrAI, an algorithmic at the core asset management firm. In this episode, Dr. Karen Williams, Chief Advisor, discusses the topic of investment risk with Dr. Homa Karimabadi, Chief Scientist, and Hudson Cooper, Director of Algorithmic Research.
Are there problems with the traditional approach to risk measurement? What do they leave on the table for investors?
So I think AlphaBytes used volatility as a stand-in for risk just because it was an easy way to think about this relationship between risk and reward that really is important. But volatility fails to capture a lot of these aspects of risk that are more important, like these extreme drawdowns. And I think these are often left out by practitioners. So volatility just describes the average size of deviations from this expected rate of return. So it can only really tell us about the size of these small, frequent losses. That's fine when losses follow a normal or bell curve distribution, and they rarely exceed 3 times the volatility. So this is a typical assumption of these volatility-based methods. But real financial data follows no such rule of thumb, and it can have losses that are many, many times larger. We call these distributions that are poorly described by their volatility heavy or fat-tailed because of the relatively large number of extreme events. So because volatility fails to describe the size of the extreme events, asset management approaches that rely on volatility alone are aligned to the extreme downturns that make investments actually risky over these longer periods of time. All of this unquantified and unmodeled risk is therefore left unmanaged, meaning that you're taking on way more risk than you actually think you are. Furthermore, under the efficient market hypothesis, rewards come directly from exposure to risk, which again is sort of this idea of the relationship between risk and reward that AlphaBytes was pushing. But if we only manage volatility, that means that we're likely leaving ourselves wide open to the other more damaging sources of risk. So it's really crucial that we use the right tools and definitions, because underestimating risk can lead us to take positions that actively undermine our investment objectives.
So Hudson, if traditional portfolios are constructed to mitigate these smaller risks, most of the people in the audience will be thinking about their portfolios, and some of them may have kind of a traditional 60-40 construction, 60% equity, 40% fixed income. Can you help us to visualize, maybe make it more real, how they would be impacted by some of these large risks?
Sure. So the traditional 60-40 portfolio it's actually a really good example of one of these traditional portfolios that's been constructed to manage volatility. Because fluctuations in the value of equities and fixed income securities are largely anti-correlated, they're able to offset each other's volatility without sacrificing too much in terms of expected returns. A 50-50 or a 40-60 portfolio works in the same basic way, but they're tuned for slightly different overall volatility tolerance levels. But getting a bit more concrete, let's compare SPY to a 60-40 portfolio of SPY and TLT, which is just an ETF that tracks the value of 20-plus year Treasury bonds. To put the two on equal footing, the 60-40 portfolio has just been scaled up a little bit to have the same realized ROI as SPY since 2003. So looking here at their largest drawdowns over this period, we can actually see that the 60-40 portfolio has done a decent job of reducing the impact of even these large events. The magnitude of the 2008 financial crisis, for example, was reduced by almost 44%, and its duration was reduced by about 43%. So the other large drawdowns were similarly lessened. So if the 60-40 portfolio has worked well in the past, why am I harping on about the ineffectiveness of traditional portfolios? So what's really crucial here is that we can't take historical data at face value. The most extreme event in history is a really poor estimate of the most extreme event that we should expect to see in the future, because in a real sense, the worst has yet to come. We need to be able to mitigate the risk of the next big, unprecedented risk, and that means that we need to be able to move beyond looking at raw historical data. By looking at how the magnitude of drawdowns change as they get more and more rare, we can infer how frequently to expect even unprecedented drawdowns, even when we don't necessarily have explicit models of the mechanisms that will cause them, right? Even if we can't directly predict them, we can still evaluate how exposed we are to these risks. So let me show you visually what I mean. This graph shows the frequency of drawdowns on the y-axis plotted against their magnitudes on the x-axis. The frequency here is expressed as the probability that any drawdown lasting at least a week meets or exceeds the magnitude expressed on the x-axis. So the scattered points correspond to historical data, where the blue points are for SPY and the orange points are for the 60/40 portfolio. And the dotted lines correspond to statistical models that let us make inferences about behavior further into the upper tail. The shaded regions are confidence intervals, and they let us express the uncertainty in our models due to the variability in the historical data. So here, we're looking at just the smallest and most frequent drawdowns, ones that occur in 90% of the cases and that are less than around 10% in magnitude. You can see a really clear separation between SPY and the 60/40 portfolio here. And this means that the 60/40 portfolio is actually able to effectively reduce the frequency of these drawdowns. And this is exactly as we should expect, since the 60/40 portfolio is designed to mitigate these small volatility-driven risks. So now let's zoom out and look at the rarer and larger drawdowns. The separation that we saw before really breaks down, particularly as we look at the drawdowns that occur with probability of less than 1%, right? These really rare ones, and that correspond to losses of 20, 40, 60, and above percent. Model uncertainty is simply too high to conclude the 60/40 portfolio effectively manages these risks. Quantifying this uncertainty is a really important step because we would otherwise feel unjustifiably safe in the 60/40 portfolio and make ill-informed investment decisions. So this means that we really can't trust that these kinds of portfolios that are often sold as safe actually protect our investments from the extreme events that are rare but catastrophic and might occur relatively frequently over longer time horizons, like those that are preparing for retirement might be facing.
What could we be doing better?
So I think that it's really important that we focus on managing the risks that actually threaten our goals. And this means that we need to move away from these volatility-based approaches to approaches that model and manage the long-term tail risks directly. So thankfully, there's a whole field of statistics called extreme value theory that's been built to estimate, model, and reason about the magnitudes and frequencies of these extreme and unprecedented events. And I showed you just a little bit of what extreme value theory can show us in the previous graphs. It has its roots in meteorology and the climate sciences, and it's used to estimate the size of, for example, 1 in 100-year floods, and to detect systematic changes in the occurrence rates of extreme weather events due to climate change. Combining this really powerful statistical framework for thinking about extreme risks with the flexibility, adaptability, and effectiveness of modern AI and machine learning has really opened the door to building portfolios that can extract profit while being far more robust to these risks that we actually care about.
Hama, how would you describe the risks of a traditional 60/40 portfolio?
The 60/40, the whole premise is based on the fact that the equities are your risky assets, bonds are the safety assets. And the reality is that's not true. If you look historically, there have been periods where the bonds have had large drawdowns. And what's more important also, if you look at this chart, you see that for all the times that people remember in recent history, we've been living in an environment of declining yields. That's led to the bull market and everything else. So in that regime, the bonds are safe, that they've served as a good hedge against the equities. But now, where the yields actually approach zero, the Fed is doing everything it can to make sure it doesn't go negative. So now we are in an environment where we are pushing for inflation with all the stimulus package and everything else. So we are in an environment of now all of a sudden a phase transition into scenario where the yields are rising. Since the yield and the price of the bonds are inversely correlated or related, that means the bond prices are going to go down. So the role of and the function of the bonds has changed in this environment. So they are not the safety asset that they used to be. And this graph shows it. If you look at since roughly June of 2020, compared to SPY and just by itself, it's been just declining. The price of TLT, which is the long treasuries ETF, has been declining, and it be expected to continue to decline as the inflation picks up and the yield continues to go up. So if bonds are not a good way to hedge, then we have to rethink this whole 60-40, not only because the bonds are not what they used to be, but also the fact that they are not dealing with the extreme events.
Hama and Hudson, thank you for helping us to understand the critical importance of large drops in portfolio value, how they impact the portfolio, how the traditional measures of risk don't capture this critical information, and how the traditional 60-40 portfolio is not really well positioned to weather them. And thank you too for pointing us to new directions for risk management. And given that risk is the key driver of the objectives that we started with, the purpose of our investments. Thank you everyone for listening, and we look forward to your questions and your comments.